Coalesce, Art of the Possible, digital broadcaster CNBC TV 18.
Hello and a very warm welcome to Coalesce 2024, Deloitte's flagship property, which brings together industry leaders and alliance partners to offer a fresh and innovative way to collaborate and co-create possibilities together. This is more than just an event. It's a journey of commitment to explore the art of the possible and push boundaries. This year, Coalesce returns stronger than ever, breaking limits and turning the power of collaboration into a driving force for acceleration. Today's session is on funding growth, the successful M&A versus IPO conundrum in a market primed for value discovery. CXOs face the critical challenge of choosing between mergers and acquisitions and initial public offerings, also called IPOs, as growth strategies. This right approach can unlock immense value, but the wrong one can lead to misaligned market perceptions. As they say, the devil is in the deal detail. Joining me today, Vivek Gupta, partner, Deloitte India, and Vishwanath Kini, senior advisor, Tech Mahindra. Welcome, gentlemen. Welcome to the show. Vivek, what a day it has been, and I'm sure there were a lot of conversations around how the markets are doing. The markets are at an all-time high. The opportunities are massive. How should companies be looking at this? I'm sure there is excitement, but patience is the key. And when we are looking at the overarching theme of this discussion, M&A versus IPO, what do you have to say to them?
So look, this is a very interesting market. And I say that, and I've often said this, when markets make available funds to businesses, businesses must raise the funding that the market offers them. However, two or three things. You must raise funding in a very disciplined way. We've often seen times where either due to debt or equity excesses, companies, founders, valuations have suffered. So raise the money that you need plus a little bit more. Don't go excessive in the market buying everything because suddenly everything appears very cheap. You may be trading at 25 times. You buy a private business at 20 times for cash, hoping you will get a valuation multiples arbitrage of 5. But that arbitrage can vanish very quickly. So I say this is an exciting time for businesses to look at, explore, consider what are the opportunities that are available, but then apply them in a very deliberate, considered, and disciplined way.
What would you say are the common mistakes then?
Look,
rushing in?
The joy of becoming larger at any cost is sometimes, I've found, the biggest bane of a founder. The kick that one gets from saying, this quarter we did $1 billion of revenue, even if half of that is acquired, is a huge kick. One has to guard against kick, and one has to see whether it's genuine business sense or not. Buying a business at 10 times, buying a business which is inherently profitable and growing at 15, 20 times may still be disciplined investing. But buying something at 50 times or buying something at a revenue multiple oftentimes will be one of the commonest mistakes that one makes in a bull market.
Vishwanath, let's move to another aspect of mergers and acquisitions, which is traditionally M&As were to perhaps scale, look at market expansion, cost efficiencies, diversification. But now there are many other things that are contributing to the strategy that is going behind M&As. What would you say are some of the trends that are emerging that are likely to rule M&As for the next few years?
Yeah, I just want to pick up what Vivek just mentioned. I think Tech Mahindra at that point of time was in 2013, wanting to acquire Satyam Computers. Now, the only reason for that acquisition was Tech Mahindra was basically into telecom vertical. So we want to diversify into enterprise, into retail, into BFSI, etc. I think at that point of time, we couldn't have done a better acquisition than getting into Satyam. Yeah, it was a risky proposition because it was filled with all sorts of litigations and issues because the promoter had already given a statement. But I think that's the risk what we had to take at that point of time. Yeah, we didn't look at any investor to do it. I think we pumped in money to acquire Satyam in 2009 and 2013 we actually merged it. Yeah, because that's, yeah, you're right. It's a traditional type of way we did it in 2013. Over the years, I think it has changed. I think now we are looking at, if are there any IPOs in the startups, or are there anything what we can synergize to a go-to market. So there are other factors which come into the play, and I think there are investors who are sitting on large cash. Probably they want to invest the right amount and have a value for money, right? And that those are the trends which I see in today's market.
Vivek, how do you evaluate the pros and cons of operating as a conglomerate versus segregating businesses for value maximization in the context of M&A and IPO?
So let me tell you something anecdotally here.
Yeah.
So in the 30 years that I've been in M&A, every 5 years the face changes. At one point in time, conglomerates were always traded at a slight premium because it was felt that risks of one business are hedged against the other.
Correct.
So it's safer, inherently, economically,
Balancing,
more balanced, and so on
yeah.
and so forth. At other times, it was always felt core focus is important because you attract the right kind of stakeholders. You attract the right kind of investors, you attract the right kind of employees and management, you attract the right kind of customers, and the company operates in a very focused way. It's a human trend. The grass is always greener on the other side, right? That being said, last 5 or 7 years, this trend reversal has not happened. I think globally we have moved to a model where we are saying core focus is far more valuable than a diversified conglomerate. Look at even the large Indian business houses. Over time, where has value been created? Value has been created when businesses have been segregated, when you have invited investors into that business who understand the rhythms of that business and who are able to value you on the valuation paradigms that apply for that business. There may be some businesses that are consumer focused. They get valued very differently, especially the build-up stage. There may be some businesses that are completely stable and mature and get valued at a multiple of their mature earnings. So the way I would answer this is, while this has been a yo-yo over the last 30 years career that I've had, but the last 5 or 7 years has told me that core focus, right investor themes is the way to go. Hopefully that will sustain, because even conceptually, this perhaps is a better economic model than the conglomerate model, which is relying only on hedging one cash flow against the other.
Noted. Vishwanath, there is a conundrum of choosing between IPO and mergers and acquisitions, and it's as a funding strategy, much like the dilemma of Hamlet's to be or not to be, actually. When we look at the options and when we weigh the two, what are some of the learnings that you have had seeing the industry, and what would you perhaps share with our viewers?
So I think what is important for an organization is where is the value lying, and whether any target would actually add value and increase growth potential, increase our P and the market share. I think that's where the industry is looking at. We have done, I think 2 years back, we have done almost like 10 to 12 acquisitions. But yeah, some have given us a good amount of returns, but some are not turned out to be the best. So, and there I think we had invested on our own. We didn't go on for an IPO. Right. But yeah, we have partnered with somebody. We had to go in for a CEO of that particular target to remain on our board. We gave them earnouts over the years because he's the guy who understands the market, and it's a different market altogether.
Vivek, a question a little different from the central theme, but I want to talk about the human face of mergers and acquisitions, and what it means for culture, and what it means for capacity building, and what it means for people on ground. Working with so many of your clients, what are some of the challenges that have come there with M&As?
I think that's a very interesting question. And in the current economic paradigm where human resources is perhaps, actually not perhaps, is most certainly the most important asset that an organization possesses, something that often doesn't get adequate attention. And I've seen this multiple times. Mergers happen on cold financial logic. Mergers happen on an Excel sheet. The EBITDA of this company is X, the EBITDA of this company is Y. We will reduce costs of Z. We are trading A times, we will now trade B times. So the combined value will be B into X plus Y minus Z, and therefore we are enhancing value. What you forget is, if you don't merge cultures properly, you're actually writing the recipe for disaster. I'll give you one fact. 86% of all large M&A fails today. Why does 86% of all large M&A fails? I think you have touched the rawest nerve of corporate India when you ask this question. So now, for example, when we approach an entire M&A transaction, and in these heady markets, the threshold levels for evaluating mergers also fall, right? This market is naturally amenable to a lot more deal activity. So when we evaluate mergers, we always have a separate track to say, how will you integrate cultures? How will you bring people together? And it's not just a question of placement within an organization. Right. It's a question of how the DNA of the organization will evolve.
When we talk about Gen AI then, and when we talk about a lot of data sets and data reading, new technologies, do you think they can offer us more insights? Are they already offering us more insights, and are they likely to offer us more insights in times to come about how a merger and acquisition may look like on ground, with the people expectations, with industry expectations, with perhaps some forecasts that they can see which we can't? Do you think we are in that space where the tech can solve this problem for us?
My organization is concerned, I don't think we have got into that space yet. Because I think we are doing Gen AI for a customer related things.
Right.
Okay, how can we really improve the customer value, customer satisfaction, etc. We haven't looked at that particular area, how we have to do an M&A, whether what could be the best target for us to acquire a company. So I think we are still in the nascent stage. I don't think we have grown to that level.
Well, thank you so much, gentlemen. May we live in interesting times, as they say. You are already living in one. And thank you for all the wonderful insights.
Thank you so much. Thank you.
Coalesce, Art of the Possible. Digital broadcaster, CNBC TV 18.